Everyone, and welcome back. Happy New Year 2024, our first conversation of the year with Austin Fitch, CFA, the highest designation one can acquire in the financial field. And I always like to mention that about Austin because it is quite an impressive designation to hold. He is the Managing Director, Consulting Solutions at Horizon Investments. He's been with us many times before. If you're just hearing him for the first time, I would highly recommend you go back through the YouTube videos that you're watching through Louis Tranquilli on YouTube. And I don't mean to speak about myself in the third person. I just mean that's why you have to search it. So Austin joins us from Horizon Investments. Really looking forward to about a 20-minute conversation. Looking forward in 2024, maybe just a peek back at 2023. That's all over now. You know, Austin, before we jump in, I just want to say that there's a term, 23 skidoo, which some of the people watching may recall that term. It's from the 30s and 40s. I used to watch a show, The Bowery Boys, on Saturday mornings when I was a kid, which was an old TV show when I was a kid. And they would say, "Come on, boys, let's 23 skidoo." And I have to say that I don't wish any years away. They're all good years, you know. We want to enjoy them. Some are just better than others. And 23 could skidoo. So if you don't know what that term means, look it up. That's what the internet is for. So Austin, with all that, welcome back. Very nice to talk with you and spend some time looking forward for clients, sharing with them some of the things that we've been talking about leading up to possibly making some changes within portfolios as 2024 gets rolling here. So welcome aboard again.
Absolutely. Thanks for having me, Lou. Looking forward to the conversation.
Always a pleasure. And you'll see up on the screen the compliance read. We no longer read that at the beginning, but we do leave it up long enough, and we'll have the read at the end. So stay tuned for that. It's riveting, of course. So Austin, I'm just going to jump in. You know, the last 3 years and a lot of prep work going into 2024. It has to include, and it always includes, in our case, a review. What has happened in the immediate past, we'll call that 2023, but even before that. So coming out of COVID 2020, there were predictions about what would happen, what would happen in 2020 with the stock market. It was going to be disastrous. And it ended up to be a decent year in the stock market in 2020. Leading into 2021, it was way overheated and there was no way it could carry on. Well, it ended up to be a really nice year in 2021. Leading into 2023, we're definitely having a recession. I mean, it was like, you know, absolute positive. You could go anywhere. I was getting calls of when is the recession going to impact the stock market leading into 2023, and that didn't happen either. So what happened?
Yeah, no, Lou, it's been an interesting, I guess, 3 going on 4 years, to say the least. And I think where a lot of folks maybe start to, I won't say get confused, but it definitely can be confusing, is we're stuck looking at history and typically looking at it through kind of a lens that we've been taught historically to look at it through. And what I'm talking about specifically right now is this idea of business cycles, right? An economic cycle. For anybody that took a Econ 101 class, right? An expansion, a recession, like all of those things, it looks like ebbs and flows, right? And I think what we haven't seen over the last 3 years is a normal or traditional business cycle. You've actually seen like a complete, like abnormal cycle. And what that draws us to is, okay, so why did that happen? What happened in COVID that led us to be kind of outside of this traditional business cycle? And we've done a lot of research here at Horizon to figure out, okay, so is there anything historically that we can maybe compare the last 3 or 4 years to? And actually what you find is the best comparison to what we've just lived through is like post-World War II scenario from an economy standpoint. And what I mean by that is you had a period where there was tons of fiscal spending in the mid 40s, right? They were just pouring money into kind of war efforts, right? You had a workforce that was completely decimated at the time because everybody was all the men at the time were off fighting, right? And then fast forward to 1946, 1947, you had this influx of labor. You had all of this excess capital in the system. Does that sound familiar, right? That's exactly what played out over the last 3 years. Now, granted, it was a little bit different, right? The inflow of capital was basically the bridge loan from the government during COVID, right? The labor market kind of ebbs and flows, right? Nobody worked. I won't say nobody, but probably workforces took a pretty dramatic hit in 2020 because of COVID. 2021, folks started to come back to work, and all of a sudden, you've got, you got your pick of getting a job because so many folks are coming back in, but there are so many opportunities there. And I think the question that we've had is, okay, so why didn't we go into a recession? Well, you're not in a normal business cycle. So all of those leading economic indicators that everybody refers to, hey, we should be worried about X, Y, and Z because that tells us that we're going into a recession. That only tells you you're going into a recession if you're in a normal business cycle. If we're coming out of, in essence, what we hadn't seen in 80 years, it doesn't tell you anything other than the fact that what we lived through for the past 3 or 4 years was about as abnormal as anybody's seen in their lifetime. So that's where, again, looking at the last 2 or 3 years, this idea of, hey, we're definitely going into a recession. Sure, I guess you can get to that conclusion if you're using kind of traditional economic theory. I think we can all agree what we just lived through, and to some extent, what we're still coming out of has been anything but traditional, right?
No doubt about it. And that's that you give me the opportunity, which I always appreciate when I get to use my own lines. Logic was out the window in 2023. Really was. It's not making excuses or anything else, but we claim no perfection. We claim the effort of being as good as we possibly can be. And I would dare say it's worked out in the past, and we'll have it work out in the future. But logic really was lacking during 2023 because, again, trying to overlay what was going on, messages coming out from the Fed and the stock market, the bond market, logic did not apply. And ultimately, that led to a good year in the stock market for indexes and for narrow portion of the market. And that, I think, is so critically important to say as many times as possible. A narrow portion of the market drove it forward. And I've said this on our last conversation with Dan Kemp of Morningstar. You could say, well, who cares? Well, we have to care. Our job is risk management. Mm-hmm. It's not unabashed growth because that comes with immense risk. So it really, what I hear you saying is that there was no recession because there was really no game plan or no previous game plan to follow. It's been abnormal for a period of time. And I think we're seeing a little bit of normalization. I could be wrong about that, but you're welcome to correct me. So that leads to the discussion about the Federal Reserve and their signaling of interest rate cuts. And I do, just for a moment, have to share that I have an article from Forbes that I will include in another video that I send out, one of the short ones. But it talks about the Federal Reserve being so bad at their own predictions. Okay, you don't want to be the negative person in the room. But you do have to point out the facts, and the facts are, if you look at the Federal Reserve's dot plotting, as they call it, DOT plotting, they're pretty bad at predicting their own actions. Okay, which could be funny, but not really when you're talking about managing assets. So the Fed signaling cuts, they haven't cut anything yet. And that's that had the questions of, well, with the cuts, what does it mean? And the answer is they haven't cut anything yet. Right. Why are they signaling cuts? Yeah,
and that kind of goes hand in hand with your comment about kind of getting back to normal, right? So they hiked rates when they did, starting, a year and a half ago at this point. They hiked rates because inflation was out of control. Let's just call it what it was, right? They had to increase interest rates to try and get inflation under control. Well, all the data that's coming out now would suggest that inflation is getting back to normal, right? Again, it depends on how you read it. Some of the data is lagged, so it's not perfect if you look at it. But I think what we would hopefully all agree on is, especially by the time you get to the middle of this year, definitely by the end of this year, inflation's probably going to be back in that normal 2 to 3% range. Okay, so why is that important? Well, if inflation's back in that normal range, long-term or federal funds, kind of the interest rate conversation needs to be back in that normal range. And when I say normal, they have this concept of kind of a long-term neutral rate, right? And typically that's right around 3%, so a little bit higher than inflation, but not much. And what you would see, or what you are seeing, and why they're signaling kind of those expectations for cuts, is if they're gonna see the data, which again we're starting to see in some of the underlying component parts, where inflation's back down to normal, they got to work to get those interest rates back down to normal. Otherwise, if they don't do that, and you had interest rates stay at 5% while inflation was at 2%, that's in essence them just putting a vice grip around the economy and continuing to tighten and tighten further as inflation falls and you're not changing rates. So they need, in essence, to lower rates to be back in line with a lowering inflation number. And that's why you're seeing them communicate it. Now, to your point, it may be 6 this year. It could be 3 this year. It could be, things change and it's 8 this year. And that's all up for maybe conversation. I don't know if you call it debate, but that will change as the data actually comes in as we get further in the year. But that's why they're communicating it, is the fact that as inflation comes down, they have to cut rates so that they're not, in essence, just completely killing growth from an economic perspective.
Okay, and that leads to the next question, and we'll talk about a couple of things as it applies to this next question. Is the consumer facing trouble? Meaning there was COVID money that was sent out at one point because of the pandemic. Consumers had a lot of cash stored, and the other thing that they had stored was debt. They had the ability to take on debt, as we have not seen in a long time. So that, along with the housing market, how does this all impact the consumer going out to buy homes, going out to buy the big screen television?
Yeah, no, and I know we've talked about the consumer for a couple times in a row now, and again, right now I think you can make the statement that the consumer is softening, but they're not necessarily soft, if that makes sense. So things are not as great as they were a year ago in terms of their financial position. And you've seen that with headlines, and again, the media will do everything they can to get eyeballs, and they'll tell you that, consumer credit is, out of control, and loans and liabilities are completely, have gone off the reservation. And I would tell you this, from an absolute dollar number, yes, consumer credit is going up, and it's going up much faster than it has been probably at any point in the last, call it 3 years at this point. That being said, you also had this massive inflow that we already talked about of kind of wealth transfer from the government to the consumer. So on a relative basis, it's not nearly as bad as those headlines want to make it believe. That being said, I think what we're watching for are those trends going to continue? Because if they continue for long enough, at some point, it maybe becomes troublesome. I think our view is right now, we're not at a point that we're terribly concerned, but we're definitely watching certain things. The consumer, again, today is actually in a decent position, softening from where they were a year ago, but not soft by any stretch. But if you look at, okay, what does the trend tell you? That's what we want to be able to say is, where are we going with this? Should we be concerned about, again, we talked about recession for all of 2023, it seemed like. I think our view is that you probably don't get a recession in 24, but it's very realistic or reasonable to think that if you start to get weakness in the consumer latter half of this year, that a 2025, even if it's a shallow recession, could be in the cards, just given the fact that, again, you've got this softening from a consumer standpoint. But you got to remember, like, the starting place for that consumer matters, and the consumer in 2021, and for that matter, even in 2022, albeit the market wasn't great, but the consumer strength like just looking at like personal balance sheets and financial statements, like was actually in a really good spot. So that's, again, I tell you, like today it's not as great as it was, but it's by no means like catastrophic.
Okay. Well, and I would say that guilty as charged. You know, I was an angry spender in 2021. Yeah. So,
right.
Yeah, I wanted to get out there and do something, and I did. You know, and hence contracted COVID 4 times so far, and officially 4 times. So there could be more in there. Anyway, so interest rates where they are right now are not, in my personal view, not having the impact, the more immediate impact that they may have had in the past, because so much of the United States have low mortgage rates.
Yeah.
They sold their home. There's absolutely no reason to refinance their home.
Right.
So the increasing of interest rates are really, to me, affecting the economy or consumers in 2 ways, and I should say also affecting companies. Companies are going to have to refinance their debt at some point. Pretty soon. I mean, if you say, well, economic cycle, we're 3 years removed from the start of COVID and all the money that flowed in and everything else from the government there. Well, at some point, companies they don't generally finance debt for 10 years generally. Right. So they're going to start turning this debt over. I'm sure they're going to start paying higher costs to refinance that debt. Or are they in a position where they're not going to have to refinance? And when I say companies, I mean big companies.
Yeah. I mean, I would tell you the CFOs of many of these big companies actually did a remarkably good job when rates were low, for locking in rates for longer than normal periods of time. And I say that to tell you that, yes, there is still the risk of kind of that maturity wall, but it's really not for another 2, if not 3 or 4 years. Like it really doesn't become an issue until late 2025, probably early 2026. And that being said, that's where you look at, okay, so what does the Fed do between now and then? Well, if they cut interest rates 10 times between now and then, yeah, it's still probably slightly higher rates than maybe what they had locked in 2 or 3 years ago, but it's not anywhere near as bad as it would be if they had to refinance today. And that's, again, that goes back to the conversation about, hey, is there a recession on the horizon? That's probably not something where pressure is put on because of where rates are for another 2 to 3 years. So you still have a little bit of wiggle room. That being said, the one piece that we've talked about internally from a rate perspective, and as it relates back to the consumer, is, Lou, to your point, I mean, everybody and their brother, refinanced whatever mortgage, however many mortgages they had, right? You're paying 3% maybe on a 30-year mortgage for quite some time. It's really affected mobility, which, I mean, I've had this conversation with my wife last month. Like, we're not going anywhere because our mortgage is as attractive as it may ever be, right? Now, granted, we're in a good spot. Like I think we're comfortable where we are, but for somebody who's locked into a place where they want to take a new job, or they want to, they need more space or whatever it may be, like that's where it starts to get a little bit iffy. And that's where you talk about consumer weakness. Like you've got folks either just not happy where they are, or you've got folks that are having to bite the bullet and take a hit from a refinance where they went from a 3% mortgage rate to a 5% mortgage rate.
Well, and to that point, I've had multiple conversations of the trade up and trade down.
Yeah.
And both are painful. Yep. Because I've had conversations of, well, I want to trade down, but I'm going to spend the exact same amount of money or even more to live in, call it 1,000 square feet less than I am right now. What would be the point of that? And of course, there is a point, but there are points to that. But really, it's conceptually a challenge, if you will, the trade up and trade down right now. And mortgages moving is a really important part of the economy. That's a non-technical way of putting it, but that is the straight way of putting it. They're very important to keeping economic activity brisk, we'll say. At some point, it has an impact, I'm sure. Now, I heard you say earlier, couple of things. You gave me a definitely, probably. So, and I like you for that, but I have to call you out on it.
Yep, that's
Definitely,
fair.
probably of 2025 recession. So I'm just going to say to everybody watching, that's worth all the paper it's written on right now. Definitely, probably 2025 recession. Sorry, but all kidding aside, I get where you're going. It's hard right now. It is very difficult to make those standard, if you will, predictions. Right. The last 3 years have made that clear, and I think we're looking at still some time. If I could give a theme to this, of things have to shake through before we see that truly normal economic cycle.
Well,
so,
and I would,
I am.
Yeah, no, and I would say this, and this is where we're kind of torn internally, and there's been some pretty serious debate, is at some point you do re-enter that normal economic cycle, right? Where it ebbs and flows and you get an expansion and you get a recession. The question that we've had and the conversation is, well, you're not automatically going to enter that cycle at what, quote unquote, maybe the beginning of the cycle, right? You may enter the normal cycle at a period where you're getting ready to go into a recession. And I think that's the conversation, is when we re-enter that normal economic cycle, where do we re-enter it? Because at some point we will inevitably be back into some sense of normalcy from an economic cycle, but it's not entirely clear where we're going to get dropped along that cycle, right?
And I think that's predictive, and that's where we can't chase what's happened.
Right.
And you can't say this is going to happen kind of thing. You can't do it because there are just too many variables. We have to make educated decisions based on historical information and with some look forward that we need to apply back to the word risk of everyone that's watching this right now. What is their proper risk? All right. So to wrap it up, a couple of things. I'd like for you to give us your thoughts on elections. Now, everyone here, of course, in America is going to focus on the presidential election 2024. However, there are in the neighborhood of 75 elections. Over 4 billion people on the planet will, I will air quote it, vote. There are those countries where it's not really a vote.
Right. Yeah.
Unfortunate, in my personal opinion, that they call those elections, but they're not. There are over 4 billion people on the planet are going to vote or some form of going to a poll in 2024. How does that affect your outlook on the stock market? We've talked about it a number of times on these conversations. Politics are always an aggravation to the stock market. Doesn't matter left, right, Democrat, Republican. Doesn't matter. They're always an aggravation. But with so many elections going on throughout the world, your take on how that impacts the U.S. stock?
Yeah, no, I mean, I think that's a very valuable point to highlight all of the other elections, because I think our view at Horizon would be that, honestly, some of the elections outside of the U.S. may have a bigger impact on markets compared to the election in the U.S. I think our view on the election in the U.S. is that you're likely to continue to have some form of divided government, right? Whether that's the Democrats retaining the presidency, you'll likely get some split between the House and the Senate, between Republicans and Democrats. And assuming you have that divided government, really what that forces is it forces the government to, in essence, do less and stay out of the way from a market perspective. And again, you can look at all the history and it tells you that in an election year, like, does it matter who wins or who loses? And there's really nothing statistically significant that would suggest, oh, if this party wins, then it's automatically good, or if this party wins, it's automatically bad. It just doesn't. The data doesn't tell you that. But to your point about elections outside of the U.S., like a great example, India's got an election coming up here in a couple months. That will be actually a pretty massive election from an emerging market perspective, because they're a big player in the EM space, and seeing what they do and the party that they elect may actually drive some emerging market returns that we really haven't seen in quite some time. Along the same front, right? You've got a Taiwan election coming up. If we're talking about geopolitics and kind of the risks that are associated with geopolitics, how that plays out can be very impactful just in terms of market volatility, right? Unfortunately, we've seen kind of wars break out in multiple places around the world. The geopolitical side of things, sadly, is becoming more and more important, and the election tying into that in somewhere like Taiwan and China is something that we're watching very closely. I mean, you go across the other side of the pond. I mean, in Europe, it's a question of, hey, we've been looking at European valuations for a decade now, right? They've been quote unquote attractive, but you've never got the payoff there. The question is, do you start to get elections that take place in Europe that maybe start to change that narrative? Those are the things that we're watching. Again, more focused there than, I won't say worried, but looking at how the election in the US plays out, because we're pretty confident that regardless of which party wins, again, that divided government piece really doesn't have a big impact in the US as much as you may see an impact in various other parts of the globe from some of those elections. So I think that's how we're viewing election season, if you want to think of it, or election year. To your point, over half the world is going to be voting at some point. And again, you can put vote in air quotes in certain places, but generally speaking, you're going to have some change in the political kind of structure around the world. And that can actually have a pretty big impact in both directions, depending on how things play out.
Yeah. And again, that's why we're appreciative of those who sit down and work through this. Horizon Investments being one of those firms for Tranquilli Financial Advisor. All right, last question. We'll make this a quick one because we're right up against the time that we promised everybody that we would take. Market outlook 2024. If you would give us, now when I say market, I have to make sure I clarify for compliance purposes, bond market and stock market.
Yeah.
What did they look like? And no return numbers, okay? Let's just talk about volatility. Let's talk about how we see the year playing out.
Yeah, I think the bond market will start there after I think what could be described as a generationally bad few years. I think the bond market does go back to kind of some sense of normalcy. And what I mean by that is, we're not targeting this specific return, but you probably get somewhere in the mid single digits, which is traditionally what you've gotten from bonds, right? It's maybe a little bit of capital appreciation, but predominantly it's going to be the yield component paying 4 to 5%, right? And that's something that we don't think there's nearly as much volatility coming in the bond space as we've seen over the last 3 years, right? As rates are starting to come back down, they're starting to get back to that neutral rate. That's a good sign in terms of bond market volatility. That's moving us in the right direction. And when I say right direction, it's moving us back to an asset class that folks can kind of rely on to be that bellwether in the portfolio. On the other side of things, we're actually pretty optimistic on the equity side of things. I mean, we talked about kind of the consumer and what we're watching, but for 2024 specifically, we think that you're looking at a consumer that at least remains strong through the majority of the year. Economic activity is actually in a pretty good spot. I mean, you can make the statement that we went through an earnings recession. So if you actually look at earnings of companies, you actually did see a couple consecutive quarters of negative earnings growth or earnings shrinking. We're coming out of that. So you're actually positioned from a stock market perspective to see a little bit more growth of earnings, which then should translate into kind of the stock market. So we actually are pretty optimistic for 2024 stocks. That's not to say that we think we're going to get another, extremely strong year like we had in 2023. But that also doesn't mean that we think just because 2023 was good, that 2024 has to be bad. We think there's absolutely the possibility for possibly even another, low double-digit type year from a stock market perspective, coming on the back of 2023, which is a pretty strong year for stocks looking historically.
All right. Well done. Austin Fitch, Managing Director, Consulting Solutions, Horizon Investments. Always appreciate the time. I'll make you commit to it in front of everyone right now. We'll do this again a couple of times in 2024, correct?
Absolutely. Looking forward to it.
All right. Thank you so much.
All right. Thanks, Lou.
This webinar was created in 2024 and is provided by Horizon Investments, LLC and Tranquilli Financial Advisor, LLC for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisors reserve the right to modify their current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk Assist is not a guarantee against loss or declines in the value of your portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when Risk Assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have Risk Assist feature. While Risk Assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that Risk Assist will always limit drawdown as designed. Accounts with Risk Assist are not fully protected against loss.